Father, in the name of Jesus, we just want to commit this session into your hands. We ask that you reveal your hearts, reveal secrets, Lord, to how we can improve our finances tonight. We ask, Lord, that you find expression through your daughter. Everything she would say, Lord, would come straight from your throne. We ask for divine wisdom, Lord, that would shine through, Lord, tonight. We just ask that you do something exceptional. At the end of today, Lord, let's have every reason to bless your name. Let your name be praised and adored. In Jesus' name, amen.
Amen. Okay. Everything finances is usually confidential. So when we ask you to complete a survey, unlike before, we are not asking you to share your name or the result of your survey. What you should do is to just use it for yourself, so that when you come to do your yearly review or half-yearly review or quarterly review or your budgeting, you can use the survey to help yourself, either as a single person or as a couple or as a group of friends who are into investment clubs and things like that. The fundamental passage that I shared on Sunday was found in Ecclesiastes 11:1-8. I also used an acronym which I've been using for several years. If you've been in New Covenant Church Edmonton, you should have been used to it now, which is easy. Everything about money may seem complicated, but it's very easy. So you have ESSI, which is earning, spending, saving, and investment. There is no human being on earth that is not either spending or someone is spending on them. So if you're a newborn baby, someone is spending money on you. Or if you're an adult and you have children, you're spending money on the children. So the spending there is a recurring decimal. You are always going to have to spend or be spent on. The earning, therefore, is more or less like a barometer of what you spend. You are either earning, spending, or you are spending and earning. The day you find yourself spending, you are not a child, you're an adult working. You find yourself spending and you are not earning, then we know where you are coming from. So very important, those two things. But because throughout our lifetime, it's either we're spending because we are earning, or we are spending because we have sown into the future. Then your money starts working for you, or you begin to rely on things like your pension, your life savings, your insurance payout, and so on and so forth. So because the earning and the spending are constant, it's very important that you begin to say to yourself, if you're out of work for 3 months, 6 months, what would you have to rely on? Okay, and you can only get to that stage if you have what we call savings and investment. With savings, it's 1, 2, 3, 4, 5 you yield, but with investment, which can go up or down, you can have what we call geometric pace or algebraic pace. So you can have 5, 10, 20, 40, but you can also come back to zero. You can go to £1 million and you can come back. So the savings and the investments are always important in helping you to maintain your spending and increase your earning. So those are the things that I think you should play with when we are dealing with the survey for this evening. So very important, because life is full of risk. And if you're able to master your risk, if you are risk averse, depending on your level of risk taking, money can be a servant to you and you can have reward of money. But you must never allow money to be your master. Don't forget that Robert Frost quote that says, nobody was ever meant to remember or invent what he did with every cent. there's no way you can remember how you spend your money unless you write them down. So we then I concluded the teaching on those 4 critical things, because we've seen in Proverbs 27:23 that we should attend the state of our flocks. If not, you'll be taking your flock to the market and you realize that your flock is not worth buying. But Proverbs 13:16 tells us that every prudent man acts out of knowledge. Every prudent man. I think if I look at it from the New Living Translation, it says, wise people think before they act. Wise people think before they act. It includes wise people think before they spend. Wise people think before they invest. So, but if you look at the other side of Proverbs 13:16, it says fools don't. Means fools don't think before they act, or before they spend, or before they invest. And the sad thing about fools is that they even brag about their foolishness, So they just say, I just bought a Bugatti. You're living in a one-room apartment in a council house. I just bought a Bugatti. You come and see, that is fool that making a lot of noise, like a clinging barrel or whatever they call it. So that passage written by one of the wisest men on earth, Solomon at the time, really touched my heart. Wise people think before they act, fools don't, and even brag about their foolishness. We then came to the 4 fundamental questions, which we're going to do quickly before we invite the speaker today. Is before you start doing anything, maybe every year, every month, half-yearly, quarterly, you should say to yourself, what do we owe? If you're married, you should be able to answer that question together. If you have a rapport where you discuss your finances, what do we owe? What do we owe? How many people are we indebted to? The second thing is, what do we own? What do we own? What are the things that we have? If you clear out all the debts, what is remaining? What are your assets? What are your assets? Then you then say, what do we earn? What do we earn? As I'm saying we, the singles amongst us should also be thinking about that. What do I own? What do I owe? What do I earn? What do I earn? Then the 4th question that you should ask yourself, where does it all go? Where is it all goes? So all this money that we've earned in the last 1 year or 2 years or 3 years, where have they gone? So very important that you ask yourself those questions. So I'm going to ask you to take 2 minutes or 3 minutes to answer that question. And I don't post it, just answer it, write it down. I'm sure some of you have written those answers there. You've looked at your asset side, you look at your credit side, you look at your debit side. One thing that you shouldn't be scared of is if you look at your debit side and you're seeing about £600,000 in debt, and you look at your asset and you see the reason why you have the £600,000 in debt is because you have mortgage. Don't be scared. The house that you live in is always going to be a liability until you sell, if there's equity, or you remortgage. Even if when you remortgage, you are piling debt onto debt. Rich dad, poor dad makes that clear. Until you then begin to buy the 2nd house for rent, the 3rd house, the 4th house, the 6th house, then you begin to have some profit. But the house, as long as you live in it, it's a liability. It's very easy to appreciate that. You pay for council tax, you pay for water. If anything breaks down, you pay for it. So you're always spending on it, and you are paying your mortgage. So don't be scared when on your debit side you see a humongous figure, but you should still see it as a debt, because ultimately what you want is to be able to look at your debit side and see 0. By the time you are getting to your 60, for those who are not thieves, who are not corrupt, who are not stealing money, by the time you are getting to your 60s, if you look at your debit side, it should be reducing. It should be reducing, and your asset side should be increasing and increasing, because by the time you are retiring, the idea is to be able to relax and allow your money to work for you. So just write those things down. What do I owe? If you take out your bank statements, you should look at the things that you are owing, write them down: credit cards, bank loans, loans to families, and so on and so forth. What do we own? What are the things that we have? Write everything that you have down. Don't bother. It could be your cars, write them down. They may be on hire purchase or balloon, whatever it is, write them down. It's your own until you return the car. You can make assessment. I won't write a car down that is on balloon because you are returning it back. That car is depreciating. By the time you return it, you have to add money. But I'll put it on my debit side. But some people will put it down if it's on hire purchase and you are probably in your 3rd year or your 4th year, and you know that at the end of the day, the car will be yours. But you cannot make a profit on the car. The day you drive it out of the dealer's house, shop, you're already losing about 10%, or even let's say 5% to be conservative. So write those things down. Don't bother about your shirts, your clothes, and all. Don't even go there. Nobody's going to wear them. The best you can get is £1 or £10 on eBay. But you can write things like your gold, your jewelry, your wedding rings, your bands, wedding bands. You can write those things down. They are valuables. You can write your shares down, your stocks, the value as of today, the dividends that are going to be declared or declared already. You can write those things down. Assets, you can write those things down. There was a day I was writing my own, and I put my children as my assets. I put them as my assets, and I've been right. I've been very correct because they have become assets to me. It's just that I can't sell them, I can't sell my children. But I'm saying to myself, on my birthdays or wedding anniversaries, they give us stuff that is an asset, okay? And I've said, I think it was 2 years ago, Love Chord, said that for me, there are about 4 or 5 places that I think I'm having an expectation of receiving an income. So as a solicitor, as a pastor with honorarium, as a coach or tutor or mentor, people give me honorarium. My children are going to give me something. My wife is going to give me something. Those are my assets. Those are places that I get serviced positively. So you can, but those ones are beginning to go into complications. You have to be able to write those down. But when you have 2-year-old, 3-year-old, maybe it's not the best time. Those ones are unfortunately quote unquote liabilities. You're going to be spending, you're going to be paying school fees and so on and so forth. So write those things down, write everything down. Then you begin to cross them out as you narrow them to proper profit and debt. Okay. Now, I believe that you have written those things and you've written them since Sunday. I've been screaming and shouting about them, and I'm sure you must have written them down. I will ask 2 questions before I invite Abby to speak to us on investment. 2 questions. 2 questions. What brings you joy in which one of these 4 critical questions bring you most joy and satisfaction? You can unmute. Where is Jay, by the way?
I'm here, sir. Sorry, I'm driving, sir, so that's why.
Oh, okay. Okay, it's all right. Don't worry.
Yes,
Out of these 4 fundamental questions, which one of them brings you joy? Anyone?
Can you hear me?
Yes.
I think for me, is it so? It's the four questions you just asked. For me,
Yes.
it's the what do I owe?
Yes.
For me, it's I am determined to be as debt free as I can. So
Okay.
more than anything, it's what do I owe?
Oh,
If
that's
my
good.
my owe balance is low, then I think I'm
Yes.
more
It's a no-brainer, isn't it? who felt it should be what do I earn? Maybe you're on £100,000 a year. That should be fancy. That should be something that brings you joy, isn't it? Why would it not bring you joy? Can someone answer? Why, if you're on £200,000 a year, that's a good quality. So why would it not bring you joy?
It can cease.
Yes, Brother Jimmy.
Sorry, I've looked at life from experience that you are only assured something when you go to bed. You don't know whether you wake up or not. So there is nothing that is certain. Nothing is certain. So yes, even though you have the potential to make so much money, but we pray for not to come across affliction, sickness, illness. There are too many things that are beyond your control. So, to me, the best thing is that, what do I owe? Even if I don't even have a job, but I don't owe anybody, I have peace. What do I owe is my key.
Okay.
So that is my key. What do I owe? Is my key. If I don't owe anybody, and even if I don't even have a job for 20 years, it doesn't bother me. Nobody will knock on my door. I don't owe anybody. What do I owe is the key. What do I?
Okay.
What do I?
Yes.
I have a slightly different view.
Okay.
In as much as I love the fact that we talk of what we owe and what we own. I'm more interested in what my income is, not just what I earn. So when I say what is my income? So what can I earn even without lifting a finger, without getting out of the bed? If what I'm earning, that is, what's the right word to use? So income that is, how do you describe income that is perpetual? Passive income. That's the right word. Thank you.
Yes.
So for me, passive income is key. So in the next 20 years, if I have things in place and I have, so much money coming in every month, every year, I'm not as concerned about my debt as long as, I can balance my book. Obviously, like you said, as you start to get older, you are, nearing 60, then obviously that can change slightly.
Okay. Yes, that's very important, especially even if you earn £200,000, if your debt on your books is 300,000, that your earning will not bring you any joy unless you have invested into very, very good vehicles. But that's it. Don't let us go too much into Abby's area. I wanted to lay the foundation so that we know how important it is to sow into the future, to sow during the rainy day. Yes, okay. Abby Taiwo is an investment guru. He will tell us briefly about our experience, then you go into your slides. Thank you. Go ahead.
Okay. Thank you, Papa, for the invitation, and I do appreciate it. I guess, Sister B, would you be able to put up the second slide, the one that's got the outline on it, please? I guess what I want us to do today is just, obviously because of time, just go through a high-level overview. We don't really have enough time to do a deep dive, but I also want us to look at busting some of the myths that we might have when it comes to investments, and then look at a few investment opportunities. And I do want to say from the get-go that if you haven't got any investments, or if you have not started, you shouldn't feel bad, condemned, or what have you. I'm going to share briefly my own experience. So just to prove that it actually doesn't matter when you start, but the important thing is to start. It doesn't matter what you start with, i.e. the amount. The important thing is to start. So for those that are on the call that don't know me, I'll just give a brief background of myself. So I've probably been working in the city now since I was 20, so that's almost 25 years. I started off on the trading floor as a stockbroker, so I am a qualified stockbroker and an accredited paraplanner. But I guess my point, getting to that point, is because I had challenges financially. So when I was quite young, you know, I did my A levels in this country, and I was a foreign student classed at the time. So I had to pay for myself. And I realized that I didn't have enough money. And I found myself getting into debt. You know, at one point I went to a loan shark, well, what they class as loan sharks, and I had people knocking on my door because I was owing a lot of money. And I got to a stage where I thought, you know, this is not the way to live. How can I, and I was earning good money, but for some reason or the other, I was just spending so much more than I earned. So it's not that I've always been good with money. And I won't necessarily say I am the best with money. I'm still learning. But, you know, I just shared that so that everybody can know that, you know, it doesn't matter where you start, but the important thing is to start somewhere. So what I want us to do today is to just go through a brief introduction. As I said, you know, Sister B, if you could go to the second slide. The second slide, so it just basically a bit about me, which I've already done. I want us to consider what our financial goals are as individuals, because not everybody will have the same investment objective. Not everybody has the same time horizon. Not everybody has the same risk appetite. We are all different. We are all different stages in the life cycle. We have different needs. I want us to look at how we actually plan our finances, how we view money in terms of, are you the kind of person that thinks that you have to spend everything that you earn? Are you an impulsive buyer? Are you a reactive buyer? You know, how do you view money generally? And what would you do differently after this session? So, you know, those are the questions that I want everybody to kind of self-reflect on and, you know, think about, you know, what you do with your money. So what I'll quickly do is, you know, let's go to the next slide, Sister B. And I'll talk quickly about, before I get into investment types, I'll talk quickly about, you know, our financial goals. So as individuals, like I mentioned previously, we're all at different stages in the life cycle. You know, people invest for different reasons. You invest because you want to make capital growth, or you also invest because you want to generate an income. Obviously, like someone previously mentioned, there is passive income, but there is also active income, which we will go into. You know, so that's one of the things. How do you also plan your finances? I find personally that when I write things down, I am more inclined to keep to the plan. I think even the Bible says it in, I think it's in Habakkuk somewhere, where it says, if you write the vision down, you make it plain. And I think statistics have even shown that when you write something down as a plan, you are more inclined to see that plan come to fruition because you're daily reminded of it. So what I do personally is I write everything down. You know, I'm the kind of person that I take studious notes. I write everything down. What do I earn? What investments do I have? What income do I have coming in? And what am I spending it on? I actually go so far as to, I have a spreadsheet that I use to manage my finances. But yeah, that's just one thing. And then how do you view money? So, you know, as individuals, and I think this is where I want to kind of bust some myths. I don't know, there are certain cultures that I think have a, how would I put it, a better relationship with money than others. I don't know if it's a cultural thing. Certain people feel like, you know, as much as you earn, people should know about it. So i.e. you go out and buy the flashy car, you want to carry the nicest bag and wear the nicest shoes, you know, and I'm not saying that is wrong, but what we need to realize as individuals is that something will have to give. If you are earning £100 and you are spending £100, you can do the maths yourself, that is zero. So I want us to kind of start thinking along the lines of, it's not just for the here and now. Yes, tomorrow is not promised to anybody, but you need to prepare for your future, because by God's grace, we will all live long and we will have a long and good future. But that's not going to come on its own. where, you know, I'm assuming everybody online is based in this country. Obviously, you know the system here, the welfare system. If you pay in enough national insurance contributions or what have you, you will get a pension. But the basic state pension, I think, is 100 and, I don't know, 15 odd pounds. It might be slightly more or less than that, but that is not going to sustain a certain level of standard of living that you might have become accustomed to in a young age. I don't think anybody, unless, you know, lots of people do enjoy working, but I don't think you want to necessarily be working into your late 60s and 70s because you have to. It's different if you just want to. You don't want to be sitting at home and doing nothing, but you don't want to be in a position where you actually have to keep working because you have not made good investment decisions at a younger age. But like I will keep saying, it doesn't matter when you start or what you start with. Okay, so what I want us to look at is multiple streams of income, how you build your portfolio, how you balance risks against your time horizons and investment objectives. And like I said earlier, mindset, it doesn't matter how you start, just start and be intentional. And I want, if there's one thing that I would like everybody to take away from this session, is commit to saving or investing something. You know, we've all been in, well, this season, I don't necessarily like to call it lockdown. I believe it's a different season. We've been all been in this season for a while. Those people that would have been going to work, what have you done with the money you've saved on commuting? What have you done with the money you've saved on buying coffee, lunch, and whatever other costs you have? What have you done with the money that you would have spent on petrol and those kind of things? So that's what I want us to look at. So when we talk about multiple streams of income, obviously the main stream of income that everybody is aware of is either your salary or your wages. But I believe as a prudent investor, you should look to maximize what you earn. So you invest in different things so that you have different income streams. So I'll give you an example. You know, a few years ago, you know, my husband and I decided to invest in a property. That property has brought us a stream of income in form of rental payment. And, you know, we invested in shares and what have you, and that also brings income in the form of dividend payments. So I want us to look at that. But before we go into that, let's talk a bit about risk appetite. So as an investor, we're not all the same. So I would consider myself as somebody that has a high risk appetite. Your risk appetite basically is the level of return you will expect for the risk of an investment. So as an example, in the slide that we can see, so for instance, a stock is a very high risk asset class, sorry. So if you have a high risk appetite, an investment manager might suggest that your portfolio is made up of a higher percentage of stock, but that would also depend on your investment objectives and how long you've got to invest. So risk appetite, you could be a high risk taker, you could be in the medium scale, or you could be a low risk taker. The other thing that you need to consider when you're making investments is, what is your objective? So an almost retired couple will have a different investment objective to, say, a newly married couple or a couple with young children. When you get to kind of closer to retirement age, you are looking for your investments to pay you an income rather than capital growth. Whereas if you're a younger couple or a couple with young children that potentially will have, I don't know, school fees, university fees in future, what you would be looking to do is to invest, say, an amount now, so that in 10 years or whatever the case may be, you would have generated enough income so that you would have the money to send your children to private school or help them to buy a house or whatever the case may be. So that's one thing. Also, time horizons. You know, when we talk about investments, we generally split them into kind of 3 brackets. You're looking at your short-term investments, which are generally 1 to 2 years. Your medium-term investment, and you know, different investment managers differ on the exact number of years, but it's generally 1 to 2 years. Medium-term investments, you're talking about, say, you know, 2 to 5 or 2 to 7 years. And long-term investments are generally anything over 5 years. Some people say 7 years, but you know, anything over 5 to 7 years is generally considered as a long-term investment. So when you're looking to, when you've taken all these things into consideration, the next thing you should think about is diversification. I will get into the asset types, but I just wanted to kind of set the scene for that. Diversification basically is just like the adage goes, don't put all your eggs in one basket. Diversification means that you are, because investments are risky, nobody can promise you 100% return. Nobody can promise you that when you invest a certain amount, you might lose some of that money. Nobody can say for a fact that whatever you invest, you will get that amount back with growth. You know, there is nobody that can promise you that. So the reason why you diversify your portfolio is to spread the risk. And you can diversify in, you know, different ways. You can diversify through different asset classes. You can diversify through different sectors, through geographical locations and regions. You can diversify across different markets as well. So that's a key thing to look at when you are building your portfolio. Diversification, I would say, is one of the best things that you can do for your portfolio. So that being said, let's get into, you know, the different types of investments that there are out there. And like I said at the get-go, for the sake of time, we can't go into everything, but on the slide here, I'm just going to pick out a few ones that, sorry, can someone please go on mute? It's a bit distracting. Sister B, can you help me out, please? Yeah, I'm just going to pick out a few ones that we could go through. We won't go through anything. And what I guess I should have said at the start, if you do have any questions as we go along, you can either raise your hand and I can answer them, or type them in the chat, or I can answer them at the end if that's okay. Okay, so the ones that I'm going to focus on today are stocks, bonds. On here is not, I haven't put gilts on here, but I will touch on gilts, which is a government form of bonds. I would also look at real estate investments, and then savings, i.e. things like ISAs, individual savings account. So, okay, if I start on the ISAs, a lot of people might be aware that every year, each individual UK taxpayer in the UK gets an ISA allowance. In the year 2021, that allowance is £20,000. It basically means that if you invest into an ISA, any profits that you generate are tax-free. You do not pay tax on them. There are different types of ISA. There are cash ISAs, there are lifetime ISAs, there are junior ISAs, which are also known as children's ISAs, and there are innovation ISAs as well. And I'll just tell you briefly what those are. So a cash ISA, as the term suggests, basically you invest cash on the savings rate. At the moment, as everybody has probably heard in the news and has probably seen, the rates are not particularly good. I think the base rate, that's the rate at which, you know, the government borrows money and lends money, is probably about 0.25% or thereabouts. So the rates that most banks are offering are less than 1%. So a cash ISA is potentially not the best if you're looking to generate capital growth or even an income stream at this point in time. You also have the stocks and shares ISA, which basically means you either kind of go to a broker or a bank. You could give your money to a bank and say, they'll probably give you a form and say, what kind of sectors are you interested in? And, you know, what kind of countries are you interested in? You fill in the form and they'll tell you, you know, where they're likely to invest your money. And that's it. They make the decisions on where to invest your money. You could open a stocks and share ISA where you manage your money yourself. So there are loads of brokers or loads of platforms where you can say invest a certain amount each month, and you decide you wanted to buy a stock in XYZ company, and you just do the transaction yourself. There is also a lifetime ISA, which a lot of people don't know about. It's actually very good for, I would say, younger people. A lifetime ISA basically has an annual subscription limit of £4,000 a year. You can only open it between the ages of 18 and 40. So if you're over the age of 40, sorry, you can't open it. But if you have got children between those ages, I would strongly advise you to let them know about this if they don't already know, and let them open one. Because the thing with the lifetime ISA, the government actually puts in, they match your contributions up to 25%. So for example, if you paid in £4,000 in a year, the government would put in 25% of that, which is £1,000, making £5,000 a year you save. As I said, the limit is 4,000. So whatever, the limit is 4,000. So the government could never put in more than £1,000 a year. But it's very good for people that are looking to buy their own home, their first home, sorry. So if you have a lifetime ISA and you're looking to get on the property ladder, just think for every 4,000 you put in, the government is giving you 1,000 and it's tax-free. So when the time comes and you see that property that you want to buy, you go and withdraw the money and you use it as a down payment on the house. I must say that generally on a lifetime ISA, you're not allowed to withdraw except for certain circumstances. So for instance, if you want to buy a property, or I think if there's an illness, or perhaps if you're over this age of 60, then you can withdraw from it. If you choose for whatever reason, there's an emergency or you really need the money, I think there's a 20% penalty, or you have to pay a 20% charge to make an early withdrawal. So lifetime ISAs are very good if you're at that stage of life. But like I said, if you're over the age of 40, you cannot open a lifetime ISA. Another little known ISA is also called an innovation ISA. And that's basically for kind of peer-to-peer lending companies or crowdfunding companies that you can invest in those. So with an ISA, what you must know is that if you opened, say, a cash ISA, a lifetime ISA, and a stocks shares ISA, your combined limit cannot be more than 20,000 in any tax year. So you could open a cash ISA, say, and put 10,000 in there, and then do a stocks and shares of 5,000, and then a lifetime ISA of the 4,000, or however you split it. You cannot put in more than 20,000 in a year. But one thing to add is you can have the ISAs with different companies. So not every company offers all ISAs. So if you decided to open a stocks and shares ISA, say with HSBC, you could go to NatWest and open a cash ISA. You're not restricted on where you invest the money. Another ISA that is very good for us as parents is a children's ISA, and that can only be opened, I think, if you've already got a child trust fund, you cannot open a children's ISA. But children's ISA has an annual limit of £9,000 at the moment. So if you wanted to invest for your children tax-free, you could put the money in there. Obviously, you can't say you're investing for your child and it's just kind of a ruse to get out of paying the tax. You cannot get the money. You would open it up in your child's name. When the child turned 18, that money would be theirs. And bear in mind, if you invest in an ISA, every year you get an annual limit. So if you invested 20,000 in an ISA, let's say this year, and let's say for argument's sake, you made £1,000 profit, or you generated £1,000, that money is tax-free. The following year, you could decide to roll over your £20,000, invest it again, and keep making profit, and you would never have to pay tax on it, subject to the annual limit. So if you invested more than 20,000, obviously you would have to pay tax on that. I guess I will pause here before I go on to the next bit and just ask, does anybody have any questions on ISAs generally, so that I can cover it before I move on? Okay, I guess I'll move on then. Okay, so we'll go on to bonds next. So basically, a bond is when you lend money to a company. That's basically what it is. So let's say for instance, a company wanted to, I don't know, expand their business. Let's take Tesco as an example. Let's say Tesco wanted to do a refurbishment of their stores and they didn't want to go to a bank to borrow money. And they thought the only way they could raise money is by offering investors a chance to lend them the money at a particular rate of interest. So let's say you lent them £100, they would say for every £100 you lend us, you would get 1% interest. That's how a bond works. Bonds are less risky than shares because you are lending a company money. Whereas with a share, which I'll get onto, you are dependent on the company making profits in order to get anything back. You're depending on the company doing well. There are other investments you can make. A gilt is like a government bond. So basically it's the same premise. A bond is issued by a company or corporation, whereas a gilt is issued by the UK government. Gilts are considered one of the safest investments that you can make. But you have to bear in mind the return that you get on investment is linked to risk. The higher the risk, the higher the potential returns, but the higher the potential losses. So you always have to bear that in mind. Is a trade-off. So you could invest in gilts. The likelihood of the UK government defaulting on on a gilt is very low. I don't think it's happened before, but I may be wrong. But bear in mind that you are unlikely to get, a huge return on a gilt, but they have a part to play in your portfolio. Like I said earlier, you've got to diversify and spread your risk. So as a prudent investor, you wouldn't want to put all your money in, say, shares and equities, because as the markets move up, they can also move down quite quickly. Whereas with a gilt or bond, the likelihood of that happening is quite slim. The way you buy bonds, you can buy them through a broker. Whereas with gilts, which are government bonds, you can only buy them through the Debt Management Office, the DMO. So if you wanted to buy a gilt, you would apply to the DMO. They would send you an application form. You would fill it in, you get on their register, and then when you see something that you want to buy, you have to fill in another form. Unfortunately, it's quite paper-based. Fill in another form, they approve you, and they issue you with the gilt. Okay, so I guess the main investment that a lot of people know about are stocks and shares. And to be honest, it is actually one of my favorites. Like I say, I feel like I've got quite a high risk appetite. So I am the kind of person that is willing to take a high level of risk to get a high level of return if the possibility is there. So shares, which are sometimes called equities, are basically an investment in a company. If the company does well, you are rewarded in, i.e. the stock price going higher or your dividend being higher. I'll give you an example. I was researching, so recently, I think it was at the beginning of March, I invested in Tesla. I think at the time it was $790. Today, Tesla is trading at 2,100 odd. As I said earlier, your investment strategy long-term is generally anything over 5 years. If you're investing in shares, I would say it's a long-term investment strategy. You shouldn't invest for less than, say, 5 years. If you had bought Tesla 5 to 7 years ago, let me just get the figures. Tesla was trading at $160. Today, Tesla is trading at 2,160 or whatever dollars. It's about an 85% rise. One thing that people might say is that, well, I don't have enough money to invest in stocks and shares. It's for rich people. Well, it's actually not. And I'm going to share a few strategies that you can, if you are interested, and don't get me wrong, it's not for everybody. It's again down to your level of, your risk appetite. If you are interested in investing in shares, there is actually a way you can do it quite easily, even with £10. So how do you do that? At the moment, I'll continue with my example on Tesla. So Tesla is trading at over $2,000. A lot of people may not have $2,000 to just go out and buy Tesla stock, but they want to invest in Tesla. There is a way you can do it through trading fractionally. So a lot of brokers at the moment offer the opportunity for you to trade in fractional shares. So that's basically a lot of companies that have very high stock prices. They, allow their stocks to be traded fractionally, which means you decide what percentage of the stock you invest in. So one share of Tesla is currently trading at 2,100 odd. You could say, actually, I've only got money for 10%, which is $210. You could buy 10% of Tesla stock today. So you own Tesla stock. Yes, you might not own a full share, but you still own the stock. So if the price goes up, you are benefiting from that anyway, because you have traded fractionally. So, if anybody is interested in trading, do bear that in mind. The higher priced stock generally they do allow you to trade fractionally. Another way you can invest in shares, and, some investment managers differ on this method, is something called pound cost averaging. Some people think it has its pros. Some people think it has its cons. I personally believe that it all balances out over time. So pound cost averaging is basically when you invest in a stock over a long period of time, but you do it in chunks. So let's say, for example, you wanted to buy Tesco shares, and I'm not saying this is the current price, it's just a hypothetical example. The price is, I don't know, £100, no, sorry, £10. So today you say, I've got this extra £10, I would have spent it on, you know, buying coffee or buying lunch. I'm going to go and buy Tesco stock, it's £10. You buy it at £10 today. In a couple of weeks, you've got another extra £10, but Tesco is trading at 11. So you think, oh, actually, if I add £1, I can buy another share. So you buy it at £11 and you carry on for say 5 weeks. Let's say the first week you buy at 10, second week you buy at 11, third week you buy at 8, 9, and 10. Over the 5 weeks, the average price you would have paid is £10.50. Let's say the stock is actually trading in the market at that time at £14. You have still bought under the price that the stock is trading. But I should caveat that nobody knows and nobody can predict where the price of a stock will go. It can go up and it can go down. I don't know if anybody's been following, what was that company that, I can't remember, there was a company recently that was doing really well and all of a sudden the stock tanked and everybody started selling off, and which everybody's been doing at the moment. Well, at the beginning of this season in March, I don't know if you pay attention to the news, you'll notice that the stock markets, they took a dive because people were panicking. And that is what you would call the herd mentality. I personally would never sell a stock when the market was distressed, because more often than not, if you buy blue chip companies, the stock is likely to rebound. But I go back to what I said about diversification. When you're building your portfolio, it is so key, even among asset classes, not to put all your stock or all your money in one place. So for instance, I wouldn't say if you were building, let's say you came to me for investment advice and you say, okay, I've got £100, but I want you to buy 10 different shares. I wouldn't put them all in technology. I wouldn't put them all in oil. I would look around and see, you look at things like the PE ratio, you look at the return on investment, you do your research. If you don't have time to do research, obviously, then you can get an investment manager, or thank God for the internet, there are so many different, you can look at Investopedia and, Which and what have you. There are so many different sites that kind of tell you what certain things are, but don't put all your money in the same place. Diversify across sectors, diversify across geographical locations, diversify across markets. Around the world, there are so many different markets. In the UK, for example, there's the FTSE 100, there's the FTSE 250, there's the A market. Don't put all your money in the same place. Some people will say that's not the best investment strategy, but for me, I wouldn't put all my eggs in one basket. And then the last thing, because of time, Papa, how long have I still got?
10 minutes.
Okay, 10 minutes. Okay, the last thing, I'm going to move on quickly to property investment. And, there are a few different ways that you could do that so that we leave enough time for questions at the end. So traditionally, a lot of people have thought if you want to invest in property, it has to be buy to let, or you have to, have a huge amount of money to invest in property. That is not the case. In the last, say, 5 years, there's this new fund that has been launched, which is called a REIT. A REIT is a real estate investment trust. So basically what it allows you to do is invest in property without owning the actual bricks and mortar. So it's basically a fund that is traded on the stock exchange. The company itself invests in commercial properties, healthcare facilities, big building blocks. And when they get their rent, they pay it out to their investments as a dividend. So in essence, you are investing in property without having the stress of having to manage it, without having to have a huge outlay of funds that you need to use from the get-go. Obviously, there are, people that still prefer to own the bricks and mortar, which is absolutely fine if you have a huge amount of money. But I guess the reason why I'm focusing on the investments that I am today is I just want to kind of use it as an encouragement for everybody that it doesn't matter how much you have to start. The important thing is to start. I remember, as I said at the beginning, I used to have a huge amount of debt. And I remember there was once I applied for something and they're like, oh, you've got like 3 defaults. And if you've ever had a default, you know it takes 6 years to clear on your credit report. I couldn't, you know, if you've not got the best credit, the offers that are available to you are a bit lower than they would have been if you look after your credit. But the point is, you need to start somewhere. Even if it's £10 that you are going to put aside a week, £10 every 2 weeks, whatever you can afford, please invest in something so that when we get to the later stage in life, we are not just relying on the basic state pension, because that won't cover anything, especially if you've still got debts. You know, the questions that Papa asked in the beginning, what do we owe? If we still got debts that you've been paying off from the past and your income has dropped, how do you pay off the debts? And most of the companies are not just going to say, okay, because you're a certain age, we're just going to leave, we're going to write off the debt. They will come for it one way or the other. If you own a property, they'll probably take out a charge on your property or what have you. But the important thing is to start an investment. So I think that's probably most of the stuff that I wanted to cover, but I don't know if anybody has got any questions. As I said, it was a very high level. There are so many different things you can invest in: mutual funds, open-ended investment companies. The list is endless. You know, people take out life insurance policies for the payout, and there are so many different things. But yeah, that was just kind of like a high level overview.
Okay, thank you very much, Apitawo. That's a wonderful presentation. You will agree with me. And we are privileged to have an investment guru in-house, someone who has worked with the stock exchange or at the stock exchange, someone who is really and truly into investments, who knows the technicalities and the shortcuts that you can use to gain profit. And so we want to thank you. We're going to take question and answer. I would recommend that you ask as many questions as possible within the time that we have, because if you had gone to the city for this training, you'll probably be dishing out over £500, if not up to £1,000. We're still going to work out maybe post-COVID when we can properly have a workshop that Abby would help us facilitate. So questions. Let's say if you want to ask question, please unmute and ask the question. If someone is asking question, mute yourself until the question that is being asked is answered. Then you can put up your hands. We have someone monitoring that. If you're on Facebook and you're watching us, please ask your questions. It will be asked on the Zoom and answered. Thank you. Questions? Especially
I think everybody is in stunned silence.
No, yeah, it's a lot to take in, but especially the young ones or the younger ones. I think that this is a critical stage for you that you need to clarify.
The ISA does not really give you any, because I've tried it and it gives me little or no return at all. I mean, apart from you saving your money, the return is absolutely zero.
Except on the stocks and shares one, but they are more risky. So for instance, I'll give you an example. I have a stocks and shares ISA, and as at today, just before I checked, I think it was 35% up. But that depends on what you invest in. Are you managing it yourself, or are you giving it to an investment manager? Are you keeping an eye on it? As I said, with an ISA, your allowance is 20,000, but it doesn't just have to be in cash.
You can do a mixture.
You can do a mixture. It could be a combination of
stocks and cash. Yeah.
But I think I do mine is of cash instead of stock. And
obviously, at the moment, the interest rates, like I said, it's very rare to. I think probably the highest rate I've seen is probably about 1.25%. Obviously, because the rates are low everywhere, so the financial institutions are not going to offer a high rate.
Why
So
not
stocks and
because
shares ISA might be it, but it is risky. I have to add that it is risky.
I was given 21p and I said,
Yeah, it's
Wow.
because of the interest rates anyway. So
Yeah.
you may want to mix it with stocks and shares, especially if you have a broker. You can speak to the broker to that.
I have a question.
Okay, yes, Mama.
I think I'm of the same opinion with Pastor Jimmy that ISA and stocks, and Abi knows my view on that, that you know, the return is very, very low, even if it's going up. Since this COVID, I've been monitoring FTSE 100, because that's what I do. And like Abi said earlier, that it went up by, is it 35 today or 65, whatever. Sometimes it goes up by 2% and it drops by 10%. For an investor like myself, I believe in long-term investment, but like Brother Jimmy, so I don't really believe in stocks and shares. I believe, number one, apart from the risk, it's just then sometimes it can become very volatile. And like I said, I've been monitoring it. Sometimes it will just be all red and my heart will do big, but I had to, what I decided to do is I cannot be having headache for everybody's collective money. So I withdrew everything. So I don't have any stock or shares anymore. The man wasn't happy, but I had to. I never paid attention to it till this COVID period. One day it will all be red and then it will be just green, it will go up and then it will go down. And then if you look at the returns, you know, you just get like maybe 50 pounds in 18 months. Yeah.
Okay, sorry, can I just say,
what's your view on that? And did I make a right decision?
I think you know what I think on your decision generally, personally, Mama. I like I said at the get-go, if you invest in stock, it's more of a longer-term strategy. Hardly would you invest in a stock today and sell it tomorrow. Most investment managers will tell you that stock market investing is a longer-term strategy. There are exceptions to that. So I generally am of the opinion that when you buy a stock, rather than the kind of looking at it and you see red and your heart is jumping, take your eyes off it. For it, like the example that I gave, and don't get me wrong, for everyone that goes up, there are some that go down. But I think overall, the blue chip companies, and especially as there are so many new innovations, companies make money because they're ahead of the game. So for instance, Tesla is doing so well because they've got a product that nobody else has. So at the moment, let's say you had bought Tesla stock, I don't know, 7 years ago. Of course, if you look at the graph, it would have gone up, it would have gone down, it would have gone up, it would have gone down. If you had held it, you would have made 85% profit. I have probably about 20 shares in my portfolio on one of the brokers that I'm with. 2 of them are in red. If I had sold them all when the stock markets plummeted, I wouldn't have made the money that I've made today. But like I have to keep saying, as a responsible investor, the stock market can go up and it can go down. That is where your risk appetite comes in. If you're the kind of person that would, you know, be concerned if you saw red on a page, then perhaps stock market investment is not for you. Or what you would do is maybe find a broker whose job it is to monitor the prices and the movements where you don't have that time to do it, because it does take a lot of work. As much as I might say, take your eyes off it, you also have to know the state of what you've got. So it's not for everybody, but I still firmly believe that it is a good investment strategy based on my experience.
I agree with you that everyone should know their investment strategy and what worked for them. But I'm just trying to share my own experience of years doing that. That I just realized during this COVID period that I don't think this is for me. Like I said, I never used to monitor it, but during this period, I just started, you know, what's the right word now? Acquiring knowledge on it, which I think I've had enough, and I just decided that no, this is not for me. There are many other investment strategies that one can go into. Yeah, so it depends on individual. And again, like you said, on our risk appetite, it depends on what you can take in and what I can take in.
And what your time horizons are as well. If
Exactly.
if you're looking for kind of a quick win, stock market investment might not be for you, because like I said, again, it's generally a long-term investment strategy. It's more of a buy and hold. Although there are stocks, and I will give, speaking openly, I can give everybody this example. There was probably in 2010, there was a particular company called Rockhopper Exploration. They're an oil mining company in the Falklands. And, everybody was talking about that stock. I did some research. It was trading at 31p. So I bought a few thousand of the stock, 1,000 as in quantity, at 31p within the space of probably less than 2 years, maybe even less than a year. I can't remember exactly. The price went to 535, and I decided I would sell it. Yes, I said it's a long-term investment strategy, stock market investing, but like I say, there are exceptions. I sold at 535. I made £5, 4p per share, and I made a few tens of thousands. But some people didn't sell, and the price went down. I'm not saying I knew the best time to get out. It's an individual thing. Nobody can tell you, okay, you've got this stock today, even if it's red, don't sell it, just have faith, because it is a personal decision and it's down to your appetite. But if you monitor the markets, or, I know, Mama, you said you've been doing a lot of research. The stock markets generally, if you look at the history over the course of time, even though the markets have crashed in March, I think they're back to higher than they were before it crashed.
You're right.
So it just depends, right? It just depends.
You are very right in that. Yes, it's gone back to normal, or even it's even gone above what it was in March, but it keeps going back and forth. So my next question now, so I can give other people the chance to ask the question, is you've mentioned long term regarding stocks and shares for many times now. So if you say this long term thing, yes, stock and shares are for long term investment. It's not something that you want to dig in today and get the returns tomorrow. But at the same time, it's not, even that long term is not guaranteed. You can put in £100 today and leave it for 5 years and get £20 out. Because I have an experience with Vodafone. I've even forgotten about the shares. This was years ago, maybe like 15 years ago. You see, after 15 years, they offered me 250. What is that? After 15 years, that is not right for a child of God. And it's not a laughing matter. Can you give me £250 after 15 years? What kind of whether it is long term or short term, in middle term, it is not nice. It is not right.
Mama, we feel you.
Mama.
For me, I don't want that.
Can I
give us another one that will bring quick money? Educate us.
Mama, can I just flip that around? Okay, let's say you had bought, because I have the impression, correct me if I'm wrong.
Please mute.
Sorry, please
mute. If you are not Abby, can you mute so that we can hear this? Yes, go on, Abby.
Yeah, I was just going to say I'll flip it around. So I suspect you're more interested in property. What if, and we're never praying that this is the case, you bought a property, at say 100,000, and over the course of time, when you wanted to sell, which has been known to happen, the housing market took a dive, and your property was worth less than what you paid for it. It can happen.
It can happen, and it has happened many times. But the but with property for me is brick and mortar. It will always be there. And once it starts appreciating, you can take your equity out, you can sell it, you can do rent for rent if you're having issues with your tenants. There are many other things you can do with it. And then you can see, I believe in saying things. I like saying my things. So that for me, that's the difference. With shares, if it's gone, it's gone. If it's down, it's down. But with property, yes, property can go down, but you always see your brick and mortar. It will always be there. At worst case scenario, you leave it for your children, or you leave it for a long term as a long term investment. I've made that mistake in the past as well. Okay, when property will go down a bit or go up a bit, you just sell immediately. You don't wait. You know, we made a lot of mistakes we make mistakes doing that in the past, and I don't think that makes sense. So brick and mortar, yes, it might go down, but you can't go wrong. You can't go wrong with landed property. Okay, let's take that offline.
We don't have enough time for that debate, but yeah.
We have a few hands. Abby, we have a few hands up.
Well, I think we need to go to others.
Yeah. Jay had his hand up. And
yes, Jay, go on.
Pastor Jimmy.
Jay, go on.
Thank you, sir. Mine was probably more a comment than a question per se. And first of all, Sister Abby, thank you for that's a wonderful presentation, very insightful, and as always. I recall that at the start of this season, to use your phrase, you actually put together a sort of mini workshop, as it were, and that was when you first opened my eyes. I hadn't really thought of stocks before, and as a result of it, I found myself having a sort of mid to high risk appetite, and I didn't know about fractional shares before, and that was actually when I started investing in shares for the first time, and you know, I've heard different comments. Of course, all investments carry risk, and you find your own risk profile and your own sort of risk appetites. I appreciate what has been done, and I appreciate what I have learned about myself and what I've learned about investing. I've referenced it a little bit when I did a presentation on Father's Day, when I talked about what I would do differently. And one of the kickstarts on the finance issue was in this area of investments. So I do think that depending on your approach to it and how you approach which stocks you select, it can be a very lucrative investment strategy. But again, it will always be a personal choice. So I just want to, that's my experience of it so far. And even from then, I think it was in April when you did that session for us, up to now, and I know it's only 4 months, but it's been quite a lucrative ride for me.
Excellent. I'll be expecting my commission then. I'm not even joking.
I should ask more questions.
Okay, whose hand is up?
Toye has a hand up.
Brother Jimmy? Toye?
Toye.
Okay, Toye.
After Toye, I will speak.
Okay. Toye, go on.
Oh, hello, good evening. Thank you, Sister Abby, for that presentation. But I just wanted to, I would swing Mama's way on this one a bit, because coming from our backgrounds, we are not, you know, it's important to understand where we are coming from, especially coming from our backgrounds, and to just get to a point like Pastor Olu said earlier about passive income. And I would, especially for the younger ones listening now, the best time to invest in the future is really now, because you've got the opportunity of time on your hands. So when you hear like the older generation speaking, you may be thinking, oh, maybe I shouldn't go into shares and stocks and stuff like that. But then for you guys, I think if you're listening, the time to invest in your future, whether it's stock, whether it's shares, whether it's anything, is now. So try and gain all the opportunities, try and take up all the opportunities that the government is giving about it now, because based on our background, we're never really taught to like save and invest in the future and stuff like that, because all we have for now is now. So that's one thing I wanted to bring out there. But swinging on Mama's way and talking about passive income, I'm a real believer of passive income. And going by what Elder Jimmy said earlier about you not ever working and you not owing anybody and you'd have peace of mind, I absolutely agree with that as well. But you need to get to a point where you have passive income. Now, properties is a good way of having investment income very, very quickly. You can realize that quite quickly. And in as much as I also go for shares, I've got shares that I've invested in for like 10, 15 years. I haven't got a dime back. I haven't got a cobble back. But as you said, it's for a long time. You keep it there. But it's been 15 years in this country and I haven't got anything from it. Maybe we invested wrongly, whatever, but that is the thing with shares. Now, if I wouldn't advise anyone who all their savings is £5,000, and it took you such a long time and discipline to take £5,000 and then you just go put everything in shares, it's your mind will be on it. Like Mama said, when you see it go red, your mind will go back, because you will be thinking that's all my savings in there. So I would suggest that if you've got time on your hands, try, and even if you can't do, like her sister Abby mentioned about taking a portion of a share, what I would also, what I would also advise is that if you have people who you're trustworthy, try and come together and get a property together. You know, the government is giving for first-time buyers now, there's no stamp duty for up to £500,000. Like, you need to get in there if you're a first-time buyer right now. So try and save together, do some rental property together with your friends that you can trust. And even if you can't, save all that money together and get that passive income. Let it start working for you straight away right now is what I would, that's my own take on it. And then you can now say, yes, I can have money for extra investments there and then.
Okay.
Well,
thanks.
let me just bring a conclusion to that. Shares versus property, real estate. It's always going to be the pros and cons for either of the investment vehicle. But I've met lots of people who say they will never touch property, and they are mega billionaire in shares. And I've met people who say, I will never touch stocks, and they have multiple properties. So it's what you feel comfortable with. I think one thing I took from Abby is that don't put your eggs in one basket, unless your basket is Moses' basket that carried Moses without drowning. So it's very important that you bear that in mind. There are many of those who say they don't like shares. If you ask them to bring the papers of the investment and the assessment and the dividends they've been given over the years, you will see that there are one or two things that probably they should have done that they didn't do. Maybe there was a recapitalization of the shares and so on and so forth. Same thing with property. Those who lost their property because of negative equity, maybe there have been instances that they should have sold and they held on and they weren't willing to hold on for a longer period, and there are circumstances. So it's best to just stay with what you are comfortable with. Very important. Okay, any other question? We can take a couple more. Yes, Brother Jimmy.
Yes. Sister Abby, this is just for you. You know, when you invest in gold, normally you don't bring home your gold bar. They only give you a document. Okay? And I was watching a program that there is not enough gold bar, that they are just sending document to you. Now what's going to happen? Can FCA give me my money back if all of a sudden I can't get my gold bar? What's going to happen?
If the company, the broker you invest in, is regulated by the FCA, there is potentially a way that you could get your money back, or not all, a percentage of it. But if they are unregulated, and I think a lot of the gold brokers aren't actually regulated in the UK, then I'm not sure how you would get your money back. To be honest, I don't really invest in gold, so I don't know much about it. But if they are regulated by the FCA, or perhaps in the country in which they operate, if they are regulated, then there is possibly a way that you can be restituted if your certificate turns out to be fake.
But Jimmy, let me add something. The gold is also like money in banks. If you put £50,000 in a bank account and you go away and say, oh, I've saved this money, that money has been lent to someone else. You know, it's been if every saver in NatWest goes to NatWest today and asks for their money back, NatWest will go bankrupt. So that is what happens to gold also. They are selling against gold held in someone's hands and gold invested in something else. So they know that it's almost impossible for everybody to make a demand. Even with treasury bills and bonds that we say they are secured, if everybody goes there and says we want our we want to cash in on our treasury bills and bonds and bills, the country will go bust. Okay, and we know that UK now is declared £2 trillion in debt. You know what that means. But because of reinsurance, people will insure banks against losses and also government backings. You will never come to a situation where the company you are investing with will just run out of money as long as they are regulated. So don't worry, don't be afraid. Let me share a story of Lloyd Webber, the theatre guru. Bought a property for £35 million, mortgaged it, and one day, I think when Labour was just about to under Kinnock, Labour was almost going to win that election. You know, Lloyd Webber went to the bank and paid off cash, and that bank became jittery because they were banking on the interest they would have acquired or accumulated with this money. So when you save with banks, they do business with it. They prefer you to be in debt so that they can make more money. They don't want you to save much. They just want you to incur more debt because that's where they make their money. So when you have your thousands of pounds in investment with them, they want to lend it out because that's how they make their money. So, but no one should be afraid of investing in gold, or as long as you are comfortable and you go to regulated brokers, you will not lose your money.
Okay, please, yes, can I say something, please? Sorry, can I quickly say something on gold for Brother Jimmy? I know the certificates that you get after investing in gold, that's your question, that's how are you sure that it is authentic? So why, I don't know the difference in the certificates and buying physical gold itself, because I know physical gold goes a long way when you want to invest as well, because it has second-hand value. You can always use it. I've used it in the past, and I'm sure many women on the forum now must have done it one time or the other in their lifetime. So, Brother Jimmy, please, my advice to you, maybe you should now turn that certificate and buy physical gold. You can, Sashade will use it, and it will still maintain the value, if you get my point, rather than just the paper. And if Sashade doesn't like it, we can use, and it will still have value. So even women, it's true. It's true. So even women in the house, please let us learn from this. We can buy gold. Gold is not a waste, it's an investment. You can always come back to it. And if you cannot buy 18 karat gold, and buy, there's something called silver 925 now. It has value as well. So you will rock it. You will rock it, you will use it, and you can still get your money back after a while. It's an investment. If you want to know about gold and 925, we can speak offline.
But then,
can we have a session on that?
It's not safe for you to keep a gold bar inside your house because you can't keep a gold bar. It's too dangerous. That's why you need to keep it in the vault.
No, but Jimmy, I'm not talking of the bar. I'm talking of the one that is already melted. The one that your wife can wear, and it will still have value. So rather than keeping the bar,
invest in your wife.
Yeah, just melt the gold. Let's adorn your wife, and it will still have value.
Praise the Lord.
Okay, Brother Jimmy. The only challenge, I think the value of the gold that Brother Jimmy is talking about, I doubt if especially can even manage that. Now, what I know is that the risk of keeping your gold in-house is so huge.
Yes.
Because I think Brother Jimmy is talking of gold,
A gold
worth
bar, a gold
maybe
bar, yeah.
100,000, 150,000, that they give you certificate that even if you don't want to keep at home.
That's correct, yes.
So I think, yes, so I think Sister Shade will be scared of putting some gold around her neck. But I see what Mama is saying. I want to wear gold also, if you give me gold. Now, okay, let's move on. Anyone else will take one more.
I have a question.
I have a question.
Hold on, Pastor Lee. Yes, Sister B?
This question was written at 8 o'clock. Can I just ask it? It says, kindly summarize very briefly the points you made on how to invest in properties without the bricks and mortar.
Bricks and mortar.
Okay. Yeah.
Okay, yes,
Okay.
quickly, then Pastor Lee.
Okay, so I'll quickly summarize. So it's something called a REIT. It's a real estate investment trust, or sometimes it's called real estate investment fund. So basically, you invest in a company that owns properties. So for instance, they might own commercial properties, they might own healthcare facilities. When they get rent on those properties, they pay it out to their investors in form of dividend income. So you do not own the bricks and mortar, you just buy in shares or units in a company that owns the property. So when they get paid, when the equity in the property goes up, you are rewarded for investing in that company. And there are loads of them. They are traded on the stock exchange in different markets if you're interested in investing in them.
Okay, Pastor Luke.
Hey, thanks a lot, Sister Abby, for the wonderful presentation, and thanks, Pastor, at the beginning for the exercise. I think it's making a lot of sense and very informative. Quick question, Sister Abby. I think I'm more like Pastor Bimbo, if I have to be honest. I like to see my investments and things like that, but I might be interested in the government bonds or company bonds. What sort of rates of return can you get on them? Like, good. What's the best rates you'd find?
Yeah, they generally tend to kind of mimic whatever the rate of inflation or the base rate is. So as I said when I was talking about the rates of return are very low because they are what are classed as a low risk investment. Obviously, if something is a low risk investment, they're not going to reward you highly for taking little to no risk. So you could be looking at 1%. There are so many different, you can buy T-bills, T-notes. There are so many different rates of return, but they generally would be in line with, say, 1%, 2%. The longer you hold them, obviously, the higher the rate of return is because you're tying up your money for longer.
Okay, so very quickly, my second and last question. There's a number of people, I know I have some of my friends on, if they need to start this penny shares or fractional shares, they want to give it a go. Are you happy to put them through? Do you offer any services that can be of use? And the part B of that is there anything you can advise us to watch out for at the moment in the market that's really hot that we can invest straight away?
I should, without putting anybody on the spot, I should let one of my a person knows that I'm talking about them because the person is really smiling. I should let one of them answer. But in terms of do I offer any services, and I'm not plugging myself. If you're interested, you are. If you're not, you're not. On the slides, my company is called Marnie Wealth Management. I do actually have clients, and I do charge a fee to manage their money. So if you're interested, you can go onto the website and book an appointment, and we can, have that discussion. In terms of can I recommend anything, you'd have to pay for that, bro. So no, but I have at the beginning of this season, and as Brother Jay mentioned, I ran probably about 8 different sessions. And one thing that I did recommend or did bring to people's attention at the time was tech stocks, because the way of working has changed. A lot of people are reliant on technology. And I know quite a few people, and I know that some people are averse to stock market investment. I will keep saying it is not for everybody. So, please do bear that in mind. a lot of technology stock that I know a lot of people and myself invested in have done very, very well. But that is just one sector. I bought some shares in, I think it was called iGlobal Clean Energy. A lot of, companies that are dealing with renewable energy. Everybody's worried about, global warming and the climate. So that could be a sector that you want to look into. But yeah, we can take it offline though if you want to go into further details. And one thing I just want to quickly add is whenever you're making an investment decision, there's something called unconscious bias. If you have had a bad experience in the past, it more often than not drives your future investment decisions. One thing that I would encourage is because with any investment, whether it be property, bonds, gilts, gold, it can go up and it can go down. Nothing is 100% guaranteed. But one thing I would say is if you do decide to get involved in any kind of investment, do not put in what you are not willing or not able to lose. If you want to start small and
very
you're
good
not
advice.
sure,
Very good advice.
do not put in what you are not
Very
willing
good advice.
or able to
Okay,
lose.
I
And
want
there
us
is a
to bring the
difference.
meeting to an end.
Yeah.
Thank you. Thank you.
Okay, that's very. Don't ever invest what you are not able to lose. Very important. Also, you may also need to start looking at Nigeria. The exchange rate is generous towards those who are foreign investors. Goldman Sachs were trading in Nigerian treasury bills some couple of months ago. I don't know whether they're still doing it. It used to attract 13% interest, and it's guaranteed. It's well known all over the world. Don't just think Nigeria is rubbish. It's a place that you can invest in. We're going to take our offering. It's a good time to offer. This is our church service, even though it's an investment class, or we're going to take our offering. And it's a very good time to sow. I want to appreciate Abby. Thank you very much for that. We'll expect you to make money out of this. So if anybody wants to consult you, you need to charge them accordingly. But if you want to do it free, that is part of your business strategy. So that's our account details. If you want to support our charity, you want to support our church, please give accordingly, and God will bless you. We'll take a minute to give. Okay, thank you very much for giving, and thank you for attending this wonderful session. We want to appreciate Abby also and all the close to over 40 people who on Zoom and the people joining us on Facebook. We'll continue on Sunday, time 10:30 to 12. We're talking about money, and we'll go on into more strategies for making and keeping money. I want to thank you once again, and I pray that the blessing of God will be upon you. Thank you very much. Bye-bye.
Bye.